Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, June 14th, 2022. And what I'm going to do in this video is analyze the charts. We're going to go through here pure technical analysis. Not a lot of talk about fundamentals and rates and all this. Other than, of course, keep in mind between today and tomorrow 2 p.m. You're going to see some volatility because we're in front of the Fed announcement, and of course after the Fed announcement we'll see some volatility. What I want to do in here is make the case at this point, try to lay out how much more downside, if any, is likely, and I'm going to kind of make three cases for three bottoms that you may want to, for those that are either short or those that are not short, looking to get long, where you can step in, and I'll kind of give you my, as I always do, which ones I think have the best chance of playing out now. So let's start out with just where we're at currently. Let's look at the 60-minute chart. I know it's a whole mess, but with a lot of lines and all that. But one thing I look for in a big trend like this, and it's not an absolute necessity, but you would be surprised how often it pans out. I like to see divergence, at least for a tradable bounce on the 60-minute time frame. And we just did have that. We had it right here. I'm going to go to a different board. I'll turn all my lines so you can see it here, but I could draw it out for you. There's a clean board right there, and that shows you the last divergent low we had on the 60-minute chart and the bounce that followed. And it was certainly a tradable bounce. It was about 12% or so. And now at this point, so what I wanted to point out is on the 60-minute chart, you can, if you want, extend that, but I'd say that divergence is now burned through. That extends out, and that fits better on the daily chart. I'll get to the daily chart in a second. So I'm going to just say this: we had a divergent low, we had a wedge break, and that's what we got out of it. And in typical bear market fashion or trend fashion, it's a counter trend trade. So I talk about this a lot. That a bearish rising wedge is going to play out a lot more and probably exceed its measured target than a bullish falling wedge when you're in a bear market or an overall bear trend. And likewise, when you're in a bull market, these bearish chart patterns tend to play out for a lot less, or much more often play out less than their measured target, if they even play out at all. And so, there's a wedge. You take the widest part of a wedge and then you add it to where the lowest point before the breakout is one method, or you can add it to where it breaks out. In a bull market, you want to add it at least to where it breaks out, and that would have been your measured target. And you can see they sold into it. So again, that's just kind of shows you, adapt to what trend you're trading, the overall trend, and you can certainly trade these bear market rallies. To make 12% in a matter of days is very much well worth it, especially for a swing trader. I mean, a lot of people are happy if they get 12% in any given year on their entire account. So to make 12% a week, get out, that's swing trading. All right, so let me just say, number one, we don't have the divergence here on the 60-minute chart. I could go through there on a lot of the key stocks and sectors as well. Some have it. Apple, for example, you have potential divergence here, and go right there. You can see potential on the PPO, but see how we've taken it out on the RSI. I prefer, and again, not an absolute necessity, I like to see it on both. So here's the thing. I think there's more downside. I'm going to show you. Let's just start out, and we're going to just look at two time frames here. Here's how we're going to do the video, so you can get an idea how long it's going to be. I'm going to look at two time frames, daily and weekly chart. I'm going to start with QQQ, and then I'm going to go through the top components, and that's it. Time permitting, I'll cover the maybe a couple of the main sectors, or even the S&P 500. But I'd rather not this video go too long. So let's start out here. So we're going to I'll go back and forth. And let's just start out with the weekly chart. Okay, you've seen this 100 times in the last couple months. My weekly chart with my targets, bear market targets. I have two trend lines that I'm using right there that I just highlighted. One is blue and one is yellow. These are the targets. Again, these targets were laid out when the Nasdaq topped. Or shortly before, shortly thereafter. I can't recall exactly when, but I give you these all year long. We've had these, and I've maintained these targets, and I do believe they're going to be hit. And again, it's a matter of how much are you going to bounce if and when each target's hit. So as a swing trader, even a somewhat, let's use the term active trend trader, if you're looking at a bear market rally that can be measured well into the double digits, potentially 20 or 30% or more, then you most likely want to, at the very least, cover some or all of your short positions to sidestep that or turn around and game it. All right. When I say game it, that means reverse and cover shorts, go to a long position. Okay, so here's the big picture on the weekly. We have that downtrend line that I did mention here was broken, taken out, and we're back testing it currently. And the problem with buying a back test on a breakout when you're back testing a trend line from above or below is a back test can continue. Number one, it can continue for a while, meaning you just drift lower and lower and you keep back testing the line, or you come right down through it. It doesn't have to have a reaction. I'm putting a higher weighting on these price targets, so let's measure this out. I'm going to move that line up and out of the way for now. From where we're trading right now, and this is what I'm going to do. And the takeaway in this video is I'm going to show you, maybe I'll loop back to the fact that we could bounce here. I did show you yesterday quite a few sectors and things at support. So there is that case. And again, I might circle back to that in the beginning. Let me just show you the potential if we don't. And the bounce here is going to entail the market liking what the Fed is selling tomorrow. Let me just say that. Again, I wouldn't expect fireworks either way, any big fireworks. Anything's possible, but we'll know after tomorrow. All right, so let's just say the market continues lower into and after the Fed announcement tomorrow at 2 p.m. My third target remains and has been all year 268. 30, and we call it 268-ish. You remember, this is a weekly chart, so you don't go down to the penny. In whether to cover, usually I will cover a short trade slightly above the resistance level. I expect a reaction. That all depends on a lot of factors. What's going on in the 60-minute charts. If I'm trading QQQ, for example, I want to also look at, I'll be looking at the futures. I'll be looking at the big market leading stocks, which we're going to go through as well. And the point is, if they are all hitting support around the same time, if I have Apple, Microsoft, and let's say Amazon all at support or breaking out short-term trend lines after divergent low, then that might be my cue to get in, cover early. However, if everything's waterfalling down, it's common, especially in bear markets or strong corrections, to get what I call momentum fueled overshoot, where you overshoot the support level that ends up holding. Technically, I don't know if you think that's an oxymoron, but I view that as holding if it's just a brief overshoot, especially intraday, only to close the day or sometimes even the week back on or above that support level. And, so therefore, if you get that and you really suspect a level is going to hold, or me at least, I can allow for wider stops and also, layer in there, and in other words, don't take a full position. Really, you got to trade it light when volatility is this high, anyways. And then once you see that level hold after the recovery, then you can jump in. All right, so let's just measure it out for you. Okay, so from where we're at right now as I'm doing the video, it is 10:20 a.m. Eastern Time. We're at 275 on QQQ, so I'm going to grab roughly from that level and down to that 268-ish level, 268.30-ish. You're only talking about 2.5%. Then you have the trend line below, and what I'm doing is I'm moving my sliding my cursor left and right, because if you hit it, let's say today, for example, it's going to measure 7% below. If you hit it in a couple days, that's 6.5%. See, trend lines are dynamic. They go up at higher and higher levels each and every day. All right, so that is just ballpark. And remember, T2 is T3 and the trend line, because all along here, I figured by the time we got there, in my mind's eye, I saw this thing playing out in this fashion, and that's why way back then I listed them as that, because they were coming in and they're close enough now, relatively speaking. Relative to what? Relative to this entire move. It's been a 32% drop so far, 33 in the Nasdaq 100. So when you have a differential of just a couple percentage points, less than 5% between the lines, that's one target for all intents and purposes. All right, so that's that. And then I have my final, what I'm calling my near term bear market target. The target I laid out in advance, and I still think it'll be hit before there's a meaningful, well, I shouldn't say the word meaningful, a lasting rally that may go for months or more. I'm talking 3 months or more. That's down here, so I'm going to measure that for you as well, and that is certainly a potential here. That is going to be about 14% from where we're at, and that comes in perfectly with this other trend line right now. That 42, that's when I measured back here. I told you how much the drop would be if you wanted to tuck away shorts and just ride the whole thing out, and that's what you would get. And if you were able to, reverse and trade some of those divergences, you've probably doubled that on your returns on trading the Qs, the Nasdaq 100 futures or ETFs. So that's it. So, okay, so the case is ABC. A, we bounce from about where we are now. Market likes what the Fed's selling. It holds up until then. B, we have about another 3, not even really about, let me do it again here, 2.5 to maybe 6% downside. We'll call it 3 to 6% downside minimal, right? And again, the takeaway here, and bear with me on this, we're going to go through the big fangs, and then the more of those, that's how it's going to work. At any point in time, the probability of a bounce increases substantially if you have one or more of those big market leading stocks, and the more of them you have, the better, all coming to support or making a case to go long any one of those. So I'm going to get to those in a second, and I know it's a lot, but this is, if you want to, it's very hard to nail tops and bottoms. That's what I do. Do I get them all right? Absolutely not, but I get a lot of them right. And things that most technical traders or any especially fundamentals forget about it. You can never nail a bottom top without using charts. It's an absolute necessity to be precise with your timing. So I'm trying to give you where we may pick it up and the way this will develop. If we have some kind of meltdown post Fed and we go quickly to that, here's another takeaway, and I know I'm digressing. Have your ducks in a row. So if you step in and buy this because it looks like we might bounce, but we just blast on through there, we take out that support. Let me just say this now. This to me is an all-in moment. This is where, just like I recently got very aggressive, I told you when Amazon fell to support and all the indexes fell to support, and those that overshot recovered it briefly. That to me was an aggressive. That was the last time I was heavily invested, and gamed actually almost all of it. Almost I wish I would have reversed at the top of the bounce, but that's where I sold the majority of my shorts as I posted that day a couple weeks ago. So that's it. There's the max target, and again, so you can trade it different ways, but I want to just measure it out. If that target is hit from here, if we go through there, that's going to be about a 15% drop in the Qs, and so keep that in mind. And I can't even give you probabilities. I think the probability is lowest that we bounce from here. Certainly a potential. Higher probability on that 3 to 6% drop, and maybe even 50-50 at this point in time. These odds, my odds change. It's just like betting. If you've ever been to the horse track, and before the betting closes, you look at the odds on a horse, they're going all over the place. It's just because as bets are being laid, the odds are changing. And same with me with the markets. As things develop, the odds can change, and can change very fast. So I'll let you know. All right, guys. So that's it. Let's just again reiterate that 3 to 6% to that target, and then worst case scenario, what I think, short of an Armageddon type crash, is 15%, where even on an overshoot with wide stops, I would start to scale in, and then once evidence of the bottom's there, again, we'll see what we develop. I'll let you know my thoughts. That would probably be an all-in moment to start buying a lot of things, and a lot of things tech. Tech will still be, at this point in time, if we get down there really beaten down and money's going to come in, you want to buy the leaders at that point in time. You want to buy crap stocks or shit stocks, low quality stocks, the GameStops of the world, AMC. You want to buy those, and it's just a frothy high end of a bull market. That's where those things outperform, and that's where the market leaders started to roll. That's what told me the top was, and we saw the market leaders dying early on, showing signs that the bull had run its, breathed its last breath. All right, let's get to the rest of the charts here. So daily charts, On QQQ, again, here's a case that you can be made that maybe we get a nice bounce starting this week, maybe tomorrow after the FOMC meeting. There's the divergent. We had divergent low 1, 17% rally. Divergent low 2, as I just pointed out, about 12, 13% rally, right? 1, 2, and this is still, let me take that back. That divergence that I'm drawing all the way across is on the RSI, but we had divergence there on the PPO. That one was just PPO and RSI divergence. This one right here, right there, was PPO divergence and RSI divergence right there, 12%, 13%, whatever it was, and you still have divergent low right now. Here's what it looks like. So you can see what I've done. We have pretty strong divergence, but it's unconfirmed, and that is to me big, 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 big. I talk about it all the time. It's a term I made up. I don't know if anyone else uses it. Unconfirmed, because to me, divergence will be confirmed when you've effectively put in a higher low. Right now we don't have that. We have, this is a momentum indicator, so is the RSI. They are pointing lower. They can continue lower, or they could turn around now. If they turn around now, and my thing is to see a bullish crossover on the PPO, then you effectively have a higher low there, and the divergence would be confirmed. So it could be confirmed like that. But what I have these lines out here because I think we go lower. Remember, divergence is not a buy signal. Positive or bullish divergence is not a buy signal. Okay. Just as negative divergence is not a buy signal, but what they are indications that a trend change, impending trend change, is highly likely. All right, and then you wait for, you couple divergences with a breakdown or a sell signal, like the trend line break there, like the little trend line break there, like the one here. We shorted there, and then once you get your sell signals, you either to short, you either wait for a short of a breakdown of support or a rally back into resistance. Okay, so where I think is probably the likeliest scenario, as I said, I don't think the bottom's in yet. We get that other thrust down. If we get it soon and it's at 3 to 6%, you can see this. This is why I have the lines out here. I'm going to pull this line down a little on the RSI. We have the potential to put in divergent low at lower levels. So this line would move like this. We just go, let me just leave that line there and then talk about this current with the PPO and the well, see, that's going to mess up the RSI. You'll still have longer divergence here, but you can see if you zoom down, the RSI is almost at, it is at the previous low right there. So this is the current divergence. So this is where the market can turn around. It'll have divergence on both the RSI and PPO. And again, guys, not absolute necessity. It's just a big part of my trading that these things, more often than not, they're pretty accurate at predicting a trend change. But you got to get a reversal here soon, or the RSI divergence gets burned through. We'll still have it from this point to this point. PPO divergence in place. Remember, there's also a lot of evidence of a top that the rally ran its course with the rejection of the PPO, the bearish PPO cross. And just that recent price action. You can see here I've highlighted these big gaps. That's something to watch too on the way up. Traders will be certainly trading off those gaps. If entered, you usually get a gap backfill, a rally back to a gap, and a downtrend line as an objective shorting op. Depends on the charts, of course. So that's daily, and I just showed you bigger picture. Now we're just going to walk down the FAANGs. I'm not going to do them all. I'll do about 5 or 6 stocks here, and then hopefully wrap this up. All right. QQQ weekly, and then we're going to go to Apple. Okay, so Apple. A lot of these charts I've not changed at the same levels I laid out months ago, and that's it. Apple, my first target, they put in after this big divergent high. You had a breakdown here. This was my primary uptrend line, or the one, the most significant, not my primary. This is the primary down here. That goes way back. You had a breakdown and a back test. That was a nice sell signal on Apple. Put in a high here, it started stair-stepping lower, and the selling has accelerated. This was the last of the FAANGs to break. And it is, and always was, for at least for years, it's been the market leader, the biggest company in the world by market cap, flirting with Saudi or Aramco, but in the U.S. I don't think I might have lost that title recently. But either way, biggest of the FAANGs, biggest holding of the S&P 500 and Nasdaq 100. Stair-stepping lower and getting to the point where we're clearly at that what I call POR. Remember, I always talk about the POR, point of recognition. That's where bulls, perma bulls, and dip buyers realize, ruh-roh, something's wrong. This isn't. I've been buying this dip. I bought the dip. But something's not working. Apple's entered that phase now. I think it's safe to say Apple's down almost 28% off its highs. So that's the biggest correction since COVID hit, where it dropped 35%. So safe to say, people are starting to take note of the fact that the bull may have seen its better days here. And again, I'm looking for a substantial bear market rally coming up, hopefully soon. Again, I'm flexible. I may pivot on that outlook, but that's what I'm looking for. So a little more downside. Apple. Let me just give you key levels. This is not a hard level. I'm going to make it a zone for you. I'm going to say right here from about 122 down to 122.20 to about 118.20. That's my next target and next support on Apple. It's broken this first target. It hit it, consolidated. I always say, initial tag of each price target is likely to produce a reaction. To me, a reaction come in one of two forms. It can be a bounce off that level of support, or it can be a consolidation. That's exactly what it was with Apple. We consolidated all around that first target there, and now we've broken it. We've taken out the lows, and that increases the odds we're going to go down to this next target. So what I'm doing for you is measuring that out. That's going to be on Apple. Again, it doesn't have to hit it. It's kind of done its own thing, but I'm just telling you where the numbers are. About 8 to 11%. Then my next target, and again, that's what we're doing this video about, to kind of gauge how far things could go, about 21%. And then my current, this is still and has been since before this stock even peaked, I believe. My current long-term final target's around 82 and it'll the primary upturn line. When I threw that target out months back, I said I know that's heresy for stock market and Apple bulls. And I think even at this point, most don't believe it. But again, that's where I think we go before all said and done. But I don't think we're going straight there. I think there'll be some nice rallies along the way. I think this bear market, it will not be like the last one. It's not going to be over before in a relative blink of an eye, 18 months or so. Again, based on my analysis, I could sit there all day long and explain why I think that is, but I think we're going to look at a much longer one. And therefore, this is where, if I am correct, you want to be a nimble or flexible trader, swing trend. You can game, when we get set up for a really nice bear market rally, you might even game that in a long-term account, or just continue to, shorten the active trading account. Up to you. So you want to see that long-term primary trend line. This is what it looks like. Comes in off the early 2010 lows. And it lines up with that final long-term target down there. So a lot more downside. But again, we're not going to get there straight away. My current max, if we get something that the rubber band snaps and we get some kind of waterfall sell-off coming up soon, and we blast through my third target on QQQ and go to T4, you're talking about 21% roughly. Or 20, nope, right about, yeah, I'll call it 20% from where we are in Apple. Again, let me just check that on QQQ. That aligns with about a 14% drop on QQQ. Okay, so go back to Apple, and that would be it. So my max current target, kind of all in kind of thing, if we get there, very good support. Look at that volume at price histogram, a lot of bars, a lot of trades occurred up into that level. That was a major reaction. There's the pre-COVID highs, and that's where I think the market's going, but I don't think Apple's going to get there. Apple's a market leader and will remain for any time in the foreseeable future. This is a company that has not doesn't have a lot of evidence that it's peaked, like an IBM or old AT&T or any of those former market leaders from yesteryear. All right, I think I covered, no, I didn't cover the daily chart. Here's the daily chart. Again, case can be made right here on the daily chart. This was a big trend line for me, a big sell signal when Apple broke it right there. It was a price channel. We have been stair-stepping lower, but as of now, again, daily time frame here, you can see that Apple, the most important stock in the entire stock market because of its weighting in this, has this bearish falling wedge, and it has Again, potential divergence. I circled that. That's a bearish PPO crossover. Last time we had a bearish PPO crossover was right there. You see what happened, and it was in conjunction with the sell signal. So again, there is that. I would be remiss not to make this case that hey, if this thing plays out, maybe they like what Powell's selling. We go and break out of this nice, bullish falling wedge pattern. But it needs to do so soon. You can see these divergences are just hanging in there, at least on the RSI. If we go a lot lower, what's going to happen is we're going to take out the previous lows on the RSI and the PPO's right here, RSI there, and then Apple. You can see on the daily chart, I don't have any support. Not that it can't stop. There's you know what? I'm going to add a line because to tell you there's no support, that's incorrect. There is support right there. Here's my support levels on Apple: 122 on the daily, 127.73, which is only about another 3.5% below us, and then that 118.73, about 10%. Next up, Microsoft. Microsoft, let's start with the weekly big picture. Took out, this was my first target. Well, I can't even remember. The trend line was probably my first target. This wasn't provided as a trade idea, just more so analysis on the broad market. Then we had the divergent high, sell signal 1 came here on the break of that trend line, hit the secondary trend line, bounced, then took it out there, sell signal number 2. Of course, you could have shorted on kickbacks to the 200 days, like I mentioned. And here we are. That was my first target / support zone, and we consolidated on it for a few weeks. Remember, weekly chart here, and we took it out, and this is really good support. The way I think, guys, here's how it works for me. These support levels, when they're pretty well defined like this one, they work almost like a magnet or like a black hole. If something gets close enough to a black hole, even light, it gets sucked in. If you hold a piece of metal close to, hold it a foot away from a magnet, no big deal. You get within a few inches, you feel that pull, and then it kind of snaps. That's typically the case during a clear trend like this, when you have clear targets. It's not impossible, but unusual to have the index itself, the SPY, QQQ, and almost all these leaders just reverse in the middle of nowhere. Once they break support, they're usually going to hit that next support level, and it won't be all of them, but the more of them that you get hitting support, again, the better chance that it's going to bounce. Why is that? To me, it's simple. I don't try to overthink things. The more obvious a support level is, the more eyes are watching it. In a market like this, the guys and gals out there professionally, or even you retail traders that use fundamental analysis, it's garbage. It's useless. I don't mean to offend anybody, but you're driving in the rearview mirror. Financial conditions will change so fast when in a correction like this, because of all the variables I talk about. I never hear anyone else talk about it. If you can project where the market's going, you can project where the consumer sentiment's going. You can project where the economy's going, because they all follow. They're all intertwined. Whether some people say the stock market looks 6 to 9 months ahead and predicts what the economy is going to do, but it's so intertwined that, like I said months ago, if I was right on my calls and where we're going, I can write the headlines for you, and the headlines have been written. You're going to see bearish sentiment. You're going to see all these bullish analysts starting to finally backpedal, revise their targets. You're going to see Powell go from hawkish to dovish, and all these things. It's this and 100 other things like that. But again, my point is, you get down there, and in a bear market, with things changing fast and volatility high, technical analysis shines. People flock to it. It's just been my experience. In a strong bull market, grind up, it's much harder. Everyone's just buying it, especially when you break out to new highs. There's no resistance overhead, so all you have are support levels to look for pullbacks on. But on the way down, this is my kind of market, because you've got tons of support levels that are very well established to find. And again, the more eyes that see them, the more chance buyers are going to step in and buy at that point. If other indicators on the chart. Again, I don't buy support simply because it's support, just like I don't short divergence just because we have divergence, because divergence tends to grow, get bigger. You can get little pullbacks, and finally, when it's big enough and then you get a nice sell signal, that's when you want to short. Okay, so back to where I was. I told you I wouldn't digress too much, but I think that's important stuff to mention. about roughly, ballpark, and would go 6% or so, no, about 5, we'll call it 5% to that first target, and this one would be a really, again, my all-in down here. So the takeaway from this is 18.5. I hope you can see my pop-up box on the left. I'll try to read it out. If not, watch when I put the crosshairs on. You get a pop-up box in the measurements right there. So that would be, again, about 18%. That would coincide with Microsoft coming back to what I call the pre-COVID highs, February 2020 highs. And so, again, if this happens fast, I can tell you this right now, you won't want to buy. You'll want to sell. You'll think the world's coming to an end, that there's no bottom of the stock market. And I cannot guarantee you at all, remotely close to guarantee that that'll be it. But if I can see Microsoft coming to this support and Apple coming to a support, or Alphabet, especially QQQ, SPY, some of the leading sectors, care less about utilities. It doesn't have much of a weighting. But if I see the tech sector, healthcare, financials, and all those at or very near some of my targets, especially with things like divergences, or even doesn't have to be divergences. I look for bearish and bullish candlestick patterns and volume patterns and things like that, selling climaxes. A lot goes into it, but I can tell you right now, it would. I'll let you know if I decide if and when we get there. And again, we could do this. So if we go here, a little bit more downside, hit these next targets, and then get a nice rally, come all the way back to the 200s possibly. That would be a rally, and I'll still maintain this target, and I'll still what I just said. I'll still whether it's 6 days or 6 months from now, or even a year from now, that we hit these targets, my longer term targets that are about 20% below. As of now, I plan to load up heavy there. And again, just how we get there, that's why I'm doing this video. And the way it works, if we start taking out all these levels that I just gave you and they're not recovered, support once broken opens the door to the next support level. So that would be it. It's simple. We're either, if I'm right on this, that scenario, we're going to have a waterfall type sell-off. We'll probably have very little, if any, reaction off these next target levels, and then come on down there. Otherwise, we bounce first, tradable rally, and then we hit those targets later on, maybe later in the summer, who knows, in the fall, I don't know, or we hit them next week. It's just as possible, guys. Like I told you, I put about almost equal odds whether we get a nice tradable rally off those next 3 to 4 or 5% downside levels, or that 20-ish% level there. Alphabet, and I didn't give you the daily on Microsoft. I don't believe I did. Same thing as see, this is, I can't ignore these. It's just how I'm wired. Traded long enough, I'm looking. What I'm talking about are these positive divergences. Now, bigger picture, see that yellow line I have right below the 0 line on the PPO? That denotes bullish and bearish trends. When you cross below, as you did here, back here, trend is bearish. That was COVID right there, and the big drop. Since then, it said, and again, look at not the orange line, look at the white line, the signal line. That's the one I use. When it's above, as it was all this time, it said be long and strong, Microsoft. You're in a bull trend. When it crossed below right there, that trend indicator flipped. Sorry, it's making a mess here. Trying to get my arrow tool. Boom, there the white line crossed below, and it said welcome to a bearish trend, and it stayed below until this point. So from there, caught all that, crossed here during that rally, got you out. Again, it's one of many things. You use it in conjunction with everything else. This rally was identified, the divergence, all that in advance, but then it's crossed back down, and it's deeply in bearish territory, and we had a rejection recently, and we're headed lower. So just like this line works as support when you're above it, look at all the kisses of the white line. Boom, boom. You could buy those in a bull trend, buy those pullbacks, buy. In a bear market, a test and a rejection is bearish. So this is something I'll be looking for if and when we cross that. We haven't done it yet. So like I said, the case right now favors more downside, but you cannot dismiss these divergences can play out. And if they do, meaning PPO turns up here, and especially if you're going to make a bullish crossover, look at the big daily divergences we have on this daily chart of Microsoft. Last time we had positive divergence was right here at about the 270 level right here back before it broke out, and that was good for a rally in Microsoft of about 17%. You can see there's a potential wedge. I'll go over bounce targets later. Again, the video will go too long if I get too nitty gritty and all this stuff. I'm just going to go a few more FAANG stocks, wrap it up. Here's Alphabet. This is Class A shares, GOOGL. This is my weekly chart. We put in the divergent high. Again, we've been diverging, and that was a divergent high and a breakdown and back test. This is all highlighted at the time. Breakdown, back test, and we had the first leg down. We ran up, made a ever so slight marginal new high, which just really moved the needle, extended the same divergences that we're building. You can see them down here. They got bigger and bigger and bigger, and that was it. That was a very significant top in Microsoft. It was a final washout move. Think of all the shorts that shorted here and then got squeezed out and gave up hope right there, and all the bulls that bought the breakout to new highs and got smoked. And that's again, you don't buy breakouts to new highs with strong divergences in place because they're likely to fail. All right, what's happened then? We all know Alphabet has dropped 33% or so, and here's what I'm looking at. So again, this point of this is to gauge how far we can go. Very impulsive move down from that last check of the 200-day moving averages right here, right? The rejection after we took them out. Impulsive leg down, followed by what appears to be a bear flag on the weekly time frame, followed by an impulsive breakdown. That's what you want to see if you get a potential bear flag. They're continuation patterns. You want to see a breakdown that's impulsive, and so far that's the early makings of that. Now sometimes these bear flags, just as they look like they're getting going, they turn around and buy them up. But if it does play out, the measured target, which is the length of the flagpole to the lowest part of the flag right here, you take that and then you add that to the highest point of the flag before the breakdown, and that's going to take you roughly to my 1700 target right there on Alphabet. So that is that is my worst case all-in scenario right there, and that's right there, 20%. This is a coincidence. This is not a trend line that I just added recently. I created that trend line back in October of 2021. So that's where we're likely going if things get ugly. Again, a case could be made that maybe it's over, or maybe we have 5-6%. So again, try to quantify them in odds. I hate to do that, but in the moving odds, let's just say 10 to maybe 15% here. We'll call it 15. No more than 20% that we bounce here. If we do 20, let's do that. Let's just make it 20% that starting with whether it's today, tomorrow, after the Fed, right before, marks a significant bottom. We have a double-digit rally. I'm going to give that, again, just imagine this is the market, QQQ or SPY, doesn't matter, or Alphabet, it's going to move with the market. I'm going to give that, just right now, as of today, 20% odds. Okay? And then I'll give I told you the other situations where that 5 or so, 3 to 6% drop, I'm going to give that 40%. And then I told you it was about coin toss odds for me, whether we have that whole meltdown thing, the rubber band snaps, and we go down about 20% roughly from where we are. Depends on what security. Those are the odds. 40, 40, 20. Okay? Trade them as you want. And the thing is, you can adjust, adapt, or stay out. There's nothing wrong with waiting for a bottom. It's great to nail the bottom. Every now and then I do that. It feels really good, and I like to get ahead on a position where you have gains, and then you can start getting real aggressive because you already have a profit, so you can layer in and layer your stops and be almost assured that worst case scenario you go all in. Like with Amazon a few weeks back, I told you I just loved that setup. It was one of the favorite I've seen in a long time in a market leading stock, like one of the big FAANGs, and I went heavy there because the risk reward was just phenomenal. Here, we'll get to Amazon. That's next up on my list. But going back to the daily charts of Alphabet, here's what we look like. You've got pretty good support here at 2005. We almost hit it there before. And you zoom in, you can see what's happened is Alphabet had a nice clean downtrend line. Again, had positive divergence right here, and it still has that divergence. Okay, so what's going to happen if we get another punch down? And again, I'm leaning that way. This is where has equal odds. That's my next downside target. One washout, maybe before, maybe right after the Fed, shortly after. That's about a 6% drop. So there's my common theme again. about 3 to 6%. And the reason I'm doing all this because it lines up. If all these stocks are, they trade together. They're tied at the hip. They're shackled together for the most part because of the way the indexes work. Money's going to fly in and out of the futures and QQQ, and it's going to move these stocks proportionally, unless there's a major event, news on one of them that can buck the trend. But typically on any given day, you're going to see 4 out of the 5 or 6 FAANGs up at the same time, or 4 out of the 5 down, and they're usually up and down roughly the same amount. Here's my preferred scenario right now with Alphabet. Come on down, hit my next support because we came close but didn't hit it there, about 2005. It's really nice. It was the bottom of this trading range. See that back here from that was March of early 2020 right there. Come down, hit that, and then in doing so extend these divergences right here and here on the RSI, and that would give a nice setup. So there it is. So about 6% or so down, maybe briefly overshoot it, and we'll see, maybe not, depends how things happen, and then put in divergence, and that would set the stage for a nice rally, again a multi-week or even a multi-month rally. Where to? I think it could carry us up back here again, still talking those 200 days, maybe another test, and or price resistance there, about 22% rally in Alphabet. Amazon, okay, this is the weekly chart of Amazon. Nope, that's the daily. Here's your weekly. All right, so this was, along with NVDA, called down with near impunity, way back here off the top. Gave a scenario of right after, was it earnings or something, of a back test, which we did. We hit it once, and we back tested one more time, and I had my arrows drawing down here to that 103.31 level. And as I mentioned, we hit it there a few weeks ago, almost to the button. And from there, it was good from that initial tag. And then we had a second, and I highlighted that 2 weeks later, a second subsequent tag. It was beautiful because you were at solid weekly support here, top of that trading range from 2018 to 2020 right there. Very, very good support. And we had bullish divergence on the 60-minute chart. And then we went on to breakout. Doesn't get any better than that for me. And it was an in and out trade. I posted the evening that it topped, literally the day of the top, along with the cues that I closed it out. It hit my second target on the 60-minute chart right there, the button. That's where I closed out, and I said all along before we even got there, that's where I'd probably be taking all my profits. In hindsight, I wish I would have turned around and shorted it and shorted the heck out of the cues. I thought we might get one more pullback and then go up to possibly hit T3, but that never happened. I've been out of it since. But here's the thing now. So okay, you had that divergent low right here. Remember, I pointed out divergent low 1, then I followed up there, divergent low 2. That was a setup, good for 23%, I think, in Amazon, 26 to the high there, about 27. But here's what we have now. We also have, I'm going to draw it for you. I'm going to just take the same line and extend it. So positive divergence, you just have to have an equal or lower low in prices, either one, with the indicators making equal, or if it's equal lows in prices, you have to have higher lows on the indicators. That's what gives it positive divergence. But you can see here we can go down a little bit. But we're going to take out we already don't have it on the RSI here. So here's my preferred scenario. I think we do go down. I think maybe we'll put in another 60-minute. We don't have to have that again. 60-minute divergences is just going to help. And I'm trying to draw it like this. Say you get another punch down, maybe a little rally here before then, backfill that gap, something like that. We'll watch it. I really, the goal here wasn't to get bogged down in the 60-minute charts. It was to tell you what's going on in the daily. So here's the thing. There was 1-2 tags of that support, and we had the reaction. There's that reaction. I define it as consolidation, which it was at first, and or a bounce, which was more so of a bounce. We had a little consolidation, then the bounce came. But we're already back there. And we also hit that target. We checked it 2 times, and we're now coming up on a third. And we are in a bear market. It got rejected to this downtrend line. That's something else to watch. So tap, tap, tap. What does that mean? Well, then we probably go on to my next target, which is all the way down here. That's a worst case scenario target right now. It will be an all-in moment for me in Amazon if we get there. I'm going to measure it for you right now. and that one's pretty. There it is. You see the pop-up box, 19.5%. So there's a common theme. If things get ugly here soon, we're looking at about 20% downside, where any shorts that I have at that point will be covered and reversed into longs, and and things stabilize, and once I see the bottom has been in, I'll go from a long to a very long position. Again, depends on the charts. If anything changes, I'll let you know. I don't have support here on the weekly on Amazon, much lower, so it doesn't. I don't have. But yeah, I told you before on everything else, I have about 3 to 6% on a lot of these market leaders. Let's see where this one comes in. That's probably going to be that same 20. Yeah, that's closer to that 18-20% drop there. So Amazon again doesn't have great support, but they all don't have to. That's why I go over the whole a lot of them, not just one or two. Finally, Tesla. Big support on Tesla. Let me go back to the weekly chart. This was a target I've been calling for a long time. That's why I colored it blue back here. And I said the same thing, that most would just laugh at that target. That was calling for from the highs. If that target is hit, that's going to be a 50% drop. So Tesla will be chopped in half. This is a log scaling chart. If you're saying, well, Randy, how's this to this 50%? Because I use log scaling. If you don't use log scaling on a company like Tesla, stock like this that's had this kind of performance, this is what the chart looks like. You can't trade that. You can't even see what the prices were back here. Log scaling puts puts the candlesticks equally in percentage moves, because when you go from 20 to 40 on a stock, you've doubled. That's a 100% return. But there was only a $20 increase in the share price. When you're a $1,000 stock and you increase $20, that's just tiny amount. It's not a double. So that's what log scaling corrects for you, and much better to use in charting, especially long term or any stocks that have had big moves on the frame that you're looking at. So there it is. We're coming up to trend line and price support. Let me measure it out for you. Another in Tesla, if hit, the blue line, the support level is about 12% lower, and depending on if and when we get there, the trend line would be about 23% lower. So that also, good step in and buy. And then look, price support as well, about 463.59, also around that level or so. So those are the things I'm going to be looking for. And the more of these stocks I see get down to these levels, even if I happen to start stepping in early, I'll add down to, but not below those levels. And again, when I say not below, if that's going to happen, we're probably going to be waterfalling down there. And again, you won't want to buy, but that's going to be the time to buy, at least for me. And just like Amazon, I didn't guarantee you it would hold that support, but I guaranteed you it was one of the best RRs I've seen in a while, meaning you buy it at that support with a stop, slightly somewhat below it, 5-6%. You can run a tight stop, but I'd say, something like that. If you're shooting for a 25-30% bounce, you can easily use a 5-6% or more stop loss. All right, that's it. I already covered the other share class, Alphabet. You can see the flag on this share class, GOG. It's a perfect. Again, that flag is that measured target comes in right to that 1700 level there. And again, to measure that out for you once more, I think that was about 20% or so. NVDA, another one called down from way back here to I gave you 4 targets actually in NVIDIA, again, I said that's probably outright heresy for bulls, and especially semi-bulls, and one of the strongest or the strongest semiconductor rally in history, calling it down from up here as much as from the highs. I started laying those targets out before that, but if that 4th target there is hit, 32.70, 90% drop. But again, that's not going to happen today, tomorrow, next week, next month, and probably not even this year. This would be a multi-year bear market target, and there will be plenty of rallies along the way to trade. But what I can tell you definitively is it broke this downtrend line, back tested again, Second back test did the trick. We had an impulsive leg down, i.e., what may be a bear flag on the weekly, followed by the flag there. There's the flagpole, flag, and it just broke down. Remember, we already hit my first target, and as I mentioned before, we hit it there 1, 2, 3 weeks. We had a bounce off that target. You could have gamed the bounce in the semis. It was about a 23, 24, 25% bounce. But that's it. There's my initial reaction. Once you have an initial reaction, that's why I list multiple price targets. That's the reaction. The initial tag, you're likely to get a reaction, and then boom, you go down to the next one. So this opens a door, and the bear flag measures roughly to my next target, and that is about 26, 27%, which jives with what I've just said on the 20% or so on most of the big FAANGs. NVIDIA is not one of the FAANGs, but it's up there. It's one of the bigger companies in the Nasdaq 100, but it's a semiconductor stock. There's more juice in the semis. If you get a correction on the Nasdaq 100, right, you're probably going to do better shorting the semiconductor stocks. Just like in a bull market, they tend to go up more. Likewise, it's just like, you know, when I said on energy sector, short XES, you're going to get more bang for your buck than shorting XLE. All right, I think I'll wrap it up here. You guys get the gist of it. I think I've been pretty thorough on my expectations and what we're looking at and levels and all that. This is a daily chart in a video, which I just flipped over to. I just wanted to show you my levels on the daily. This one's not great, but it is the next support level I've had here for a while, about 147.65. That's a better support level, 125.23. In other words, I would be happier buying down here, loading the boat at, again, right at about a 20% drop. So for the 20% drop to happen soon without a sizable tradable counter trend bounce, it's probably going to come in the form of a pretty quick crash type scenario. As impulsive as the selling's been for the last few days, we haven't had the circuit breakers kick in yet. If you're new to trading a bear market and you're on the wrong side of it, you won't know pain until you get in one of those waterfall type sell-offs. Again, if it's going against you, and you know, if you can trade it successfully, if you want to game it, I just showed you, there's a decent chance of a 20% or so drop from here. That's enough meat on the bone to still be short, and most people don't want to probably be short right now. Again, you got the Fed coming up tomorrow. No reason to go heavy short into that unless you're just an out-and-out gambler. Unless you're the one that likes to go to Vegas and stick all your money on the one-arm bandit, or, you know, go and bet it on a red 27 or whatever on the roulette wheel. That's that type of person that would go aggressively long or short right now. You can take a position. My bias is short right now. I'll be clear on that, but cautiously short. So I don't have, you know, I'm not loading the boat at this point in time. All right, I'm going to wrap it up here. Oh gosh, that was a long video. Didn't realize it, but hopefully that's a good one, guys. This is the important stuff. If we can get in there, milk the last bit of the downside, and then especially turn around and trade the next tradable bottom, I think it'll be worth your while to have sat through this video for 50 minutes. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.